watching from. Maybe you can, again, text like last times. We had some people from Turkey, from Nigeria, etc. So feel free to use the comments box. Yeah, by saying this, we can switch to the next slide. So yeah, here you can see a short overview of what we will cover. We'll talk about portfolio risk management, trading, investing strategies. We will differentiate between day trading and swing trading. We've mentioned already these terms in the last webinar. Module 3 will talk about trading, investing strategies like scalping and buy and hold. And module 4, obviously there are like various technical analysis indicators that you can use in order to mitigate the risk of an investor. And lastly, we will dive deep into a question of how to build a well-balanced crypto portfolio. So portfolio risk management will cover these 4 topics, and I think we can jump right into the first one. So what is portfolio management? So if you imagine like a portfolio is a collection of various assets and investments. So just like you can strategically manage your individual assets or investments, you can also strategically manage your portfolio as a whole. So a portfolio, you know, can contain real estate, can has like stocks, cryptocurrencies, and even like trading cards. You have some trading card games such as Pokemon. You have entertainment trading cards featuring, you know, various characters from movies, TV shows, and video games. And anything you can invest in can be part of your portfolio. If you're only trading cryptocurrencies, it will likely be made up of a combination of Bitcoin and other altcoins. And each part of your portfolio can work together to create an overall strategy. The first step to a good portfolio management is setting your expectations. So are you risk averse and looking like for a basket of investments protected from volatility? Or do you want something riskier with like potentially higher returns in the short term? So there are like endless possibilities of how to put together your portfolio. Again, it can be very complex, it can be simple, but it's recommended, you know, to do your own research and to put, you know, some thoughts in it because you are investing with your money, right? So also the amount of time you want to invest matters. So you could take like a passive approach, like a hands-off strategy, and leave your investments alone after you set them up. On the other hand, you can take like a more active approach, you know, continuously buying and selling at various price targets and benefit from these price movements of the respective underlying. So both active and passive strategies have their merits, and the choice between them depends, again, on you, on your individual goals, on risk tolerance, time commitment, and investment knowledge. And some investors, you know, prefer a mix of both approaches, you know, blending passive investments for long-term growth with active investments with specific, you know, opportunities or sectors you feel confident in. Let's move to the next slide. It's about risks. You know, obviously, when you are investing, you always need to consider some risks that are involved. So the first one you probably heard about is market risk. So this is something you cannot like completely eliminate. You can manage it, you know, through diversification and some risk management techniques. Yeah, and just to define it, you know, it's basically the loss or the potential loss you may experience if the asset loses value. The second one, the second famous risk type is called liquidity risk. So this occurs, you know, in illiquid markets where you cannot easily find buyers or sellers. So liquidity risk can be a concern for investors who cannot sell their asset at the price they want. So and also if you need, for instance, to meet your financial obligations, this is something you should also consider. So it's commonly associated with investments such as real estate, private equity, or certain bonds with limited trading activity. And then you have something called operational risk, where potential losses stem from operational failures, such as human error, hardware, software failure. And finally, there's systematic risk, so including possible losses caused by the collapse of the entire industry, market, and financial system. So one example would be Lehman Brothers back in 2007 and its effect on the global financial industry. And when systematic risk basically materialize, they can trigger, a domino effect, as I've told you, like the financial crisis back in 2008. So each asset you have in your portfolio will have some risk associated with it. For example, a new cryptocurrency without a large market for buyers will have more liquidity risk, but the risk won't always be internal and manageable with your portfolio. So sometimes external factors like our Lehman Brothers example or a global recession can't be avoided. And managing these risks, involves strategies, which is what are we talking about today, including, again, diversification, risk assessments, hedging, stress testing, and various risk management practices. And investors and financial institutions, they closely monitor and evaluate these risks, to make informed decisions and protect themselves from potential losses. So now, after we've covered the various types of risks, we will move forward to assessing the risks. So how would you assess the risks? So the likelihood basically of encountering them and their severity. So an excellent place to start is by ranking your investments from high risk. So it's basically the top to low risk. So from there, you can check each asset's price volatility, liquidity, industry health, and other related news. So after identifying your higher risk investments and the kinds of risk they have, the next step is to decide how much you want to offset that risk. So for example, if you have many crypto investments, you may want to balance this out and diversify with, for instance, with government bonds or other low risk investments. So you can also allocate your assets strategically within an asset class, such as stocks or crypto. And you could also get stocks and utilities or technology companies if you have a high systematic risk from holding stocks all within the financial industry. So great, you should now know by now the most essential concepts within portfolio and risk management. And we will begin learning different trading investing strategies in the following 2 modules.
Mahmoud, maybe let me jump in here because this one is interesting. So ideally, we would like to give our audience and viewers a little bit more better understanding beyond crypto, right? A general framework and general understanding of assessing risks. Where would you see? And I'm just having fun here, right? Like I would like to give you some assets. Where would you like rate those? So maybe like art. I couldn't find art in the list. Where would you evaluate art? Picasso and the Mona Lisas of the world. Where would you rank those in terms of risk?
Very good question. I mean, the ranking of these assets, including art, for instance, they depend, on various factors. So first, obviously, the demand, the condition of the art itself, market trends, and rarity. But art can be it's a valid question first. It can be highly valuable, especially if created by a renowned artist. So the value of an art is also very subjective, can fluctuate based on factors like the artist's reputation, then you have like historical significance, conditions, current market demand. So it really depends. I cannot tell you. It depends on the art itself. So I cannot give you like a one size fits all to this question. But it's a good one.
Yeah, it's a broad one, right? Like for example, NFTs is also a huge range as well. So where would you like rate those? I also agree. I think it's really a variety of factors. Maybe ask the audience if they have some examples. Another example I could come up with is watches, like in particular maybe luxury watches. Where would
Yeah.
you rank those?
There are watches of, I'm having one from Citizen, for instance. It's very risky as an asset class, I would say. But again, it depends if on the limited editions, if they have like, again, historical significance or made by prestigious brands, like for instance, Rolex. So it really depends, on the brand itself. So if you put Rolex, I wouldn't say it's risky because it has like a growing trend in terms of value. But yeah, it depends on the brand again, whether it's limited or not in terms of editions. Yeah, you can argue the same thing with a wine. Wine could be also an asset class, So it really depends on the reputation for if we pick wine, producer reputation, region, condition, rarity. So there's a lot of factors which we need to consider when assessing the risk level of these assets. But me personally, I wouldn't invest, in watches as an asset class.
Yeah, it's definitely some sort of niche. I was looking if there's any other examples from the audience, but I think we can move on. Thank you for clarifying.
Okay, no worries. Yes, so I think we have like a quiz question for you guys. Please be interactive like last time. Really appreciate this. I'm gonna read out the sentence again. Which of these are correct? So choose more than one which applies. So first is systematic risk is the potential for loss from human software or hardware error. B, liquidity risk is the potential for loss from not easily finding buyers and sellers. C, operational risk is the potential for loss from an asset losing its value. Or is it D, market risk is the potential for loss from the collapse of an entire industry or market? So this time it's only one which is correct. So just to give you kind of a hint. So you can use the comments box and choose the correct answer.
I think you covered it. You covered it. Previously quite well. So anyone who paid a little bit attention to it should be not that difficult to not guess, but to choose the correct answer from. So let's give maybe 10 more seconds.
Sure. I'm also checking on my phone.
I see a couple of D's.
D? Oh, okay.
Yeah, D. A couple more D's.
Yeah. So I think I can reveal it, right?
Sure, go ahead.
So it's B. So obviously, liquidity risk, as we've mentioned before, is just like the loss, from not easily finding buyers and sellers. For instance, a very illiquid market is the real estate market. You cannot easily sell the real estate. So yeah, but D, market risk is the potential for loss from the collapse of an entire industry or market.
Actually, D is also no kind of legit or not.
D is also valid, I feel.
I also feel so, right?
Yeah.
I think maybe the persons who mentioned D seems for me valid as well. So I think maybe we can pass it as well.
Yeah, sure. So let's go with B and D. Like, congrats. All right. let's move forward with day trading and swing trading. So we're gonna start with day trading, and let's jump right into it. So if you've ever watched, movies about trading and Wall Street, you're probably already familiar with what day trading is. And while the movies can be a little outdated with, stockbrokers shouting over each other furiously on the trading floor, the basic concept is still the same. So as you might have guessed from the name, day trading means entering and exiting a trading position within the same day. And this means a day trader starts their day holding no stocks, purchasing them during the day and sells them by end of the day. As simple as that. And in traditional markets, this occurs within the exchange trading hours, obviously. For example, let's say a trader starts their day at 9:30 in the morning when the New York Stock Exchange opens. They have no positions at that time, meaning they currently own no shares. So the trader then begins, to look for stocks they believe will rise in value within the trading day. And they can base their decisions perhaps on some expected news of a company, which will be released at that day, the price of a stock at closing time the day before, or other informations you can have in the news. So the day trader identifies, for instance, Boeing and Coca-Cola as their target stocks. So Boeing is due to release details of the development of a new plane at midday, and Coca-Cola finished its trading day yesterday at an undervalued price based on their fundamental analysis after a big sell-off. Over the day, both stocks begin to rise, and the trader sells them for a profit. So in our previous webinar, you will remember that technical analysis is well suited to short-term trading. So gains in such short period can be minimal and sometimes don't just relying on fundamental value of an asset. So day trading, just to wrap up, is a very active trading strategy that requires significant time investment. It can be highly profitable, but it also has a substantial amount of risk. As such, day trading, at least from my perspective, is generally better suited for more experienced traders. Let's move forward with the next one, which is swing trading. So it has some similarities, with day trading, but it works over a longer time frame. So positions that are usually held anywhere from a couple of days to a couple of months. And the goal here is to profit from larger swings in price, so larger fluctuations, price movements. So your goal as a swing trader is to identify assets that could be undervalued and are likely to increase in price. So in this case, you would purchase the asset and sell it when the price rises, and you generate like a minimal amount of profit. And the opposite trade looks to profit from downward price swings. Let's give you an example. Bob, for instance, has 1 Ether, and the current market price is 2,000. So Bob's analysis predicts that Ether's price will drop from 2,000 to 1,000 in 2 weeks. So Bob shorts Ether. So basically, he's borrowing the asset, and sell it at a later point in time. So he sells his Ether today for $2,000. And waits to see if his prediction is correct. So 2 weeks later, Ether dropped from 2,000 to 1,500. So although he wasn't 100% accurate with his analysis, Bob still has the opportunity to make some profit. So Bob purchases back his 1 ETH for 1,500, leaving him with a solid profit of $500. So swing traders, they commonly use technical analysis like day trading, but as their strategy plays out across a more extended period, fundamental analysis is also like a valuable tool for swing traders. So using them both together can create, an even more robust analysis to base your trading on. Just to compare with day trading, swing trading requires, less of a time investment than day trading, significantly also reducing the stress, and adrenaline traders will feel. And compared to day trading, swing trading is a much more suitable strategy for beginners. And yeah, in the next module, we will learn two different strategies called scalping and buy and hold. But before moving there, we have a quiz question for you again.
Mahmoud, one more thing, maybe. How does Bob know, like for the general audience, I think some may have this question, how does Bob know when actually to exit a trade? So not just as a swing trader, but also day trader as a general rule of thumb. Do you have some, indicators or suggestions when to exit a trade?
Yeah, so obviously there are various technical indicators that Bob can use. But obviously, I mean, as an investor, you should stay informed about recent news, market catalysts that could, significantly impact the price of the asset you are trading. Yeah, I mean, it really depends. He can use, for instance, various price targets. So you can set price targets based on your analysis and trading strategy. Obviously, he might has a trading strategy. He wants to exit with a profit of 500, for instance. And with these price targets, they can be determined by identifying key support and resistance levels, chart patterns. You have, like, for instance, Fibonacci retracement levels that can be used as well. So when the price reaches your target, you consider basically closing the trade. Another thing that Bob might have used is like implementing trailing stops, to protect your profits and allow for potential further upside. So as the price moves, for instance, from for ETH in your favor, it will adjust, your stop loss level to trail a certain distance or percentage below the current price. So again, there's like various technical indicators that he might has used, for this trade.
I think also it comes down to the first module you mentioned about risks as well, right? It also
Exactly.
depends on that as well. So, but yeah, hopefully there are some indicators or some insights that everyone could be a little bit more aware of that you just shared now. So yeah, then let's jump into the quiz, I would say, right?
Yeah. So which of the following statements are correct? Choose all that apply. A day trader starts their day holding some stocks. B, day trading requires a significant time investment. C, swing trading positions are usually held anywhere from a couple of days to a couple of months. Or is it D, swing traders commonly use fundamental analysis? So we give you also like a couple of seconds.
Maybe give a small hint. Is it this time one or multiple?
Yeah, it's two, basically. It's two. Yeah.
Two. Yeah.
So are you tracking the comments box?
Yeah. A couple of A's, B, D, but most guess A. I think we
Okay.
can review.
So it's not A, unfortunately, because again, a day trader starts the day without having any assets, any positions. So it's different, for instance, from a swing trader. It's B and D because B and C, sorry, because as I've mentioned, day trading requires significant time investment because you try to benefit from these short-term fluctuations. So there are like multiple trades that you are doing per day. C, it's swing trading positions are usually held anywhere from a couple of days to a couple of months. Yeah, this is also something that I've explained before. Again, day trading is you buy the assets and you sell it at the same day. Swing trading, you buy the assets, for instance, today, you're going to sell it next week or next month or in 3 months. So you hold the asset for a longer time period. And that's why you are using, for instance, for swing trading, also the fundamental analysis more than the technical analysis compared to day trading. All right, Volkan. Then I would like pass the ball to you, right, with module 3 about scalping and buy and hold.
Thank you very much for the first two modules. So for this module 3, we are going to do a little bit more dive deep into scalping and buy and hold strategy. So let's start directly with scalping. So what is scalping? So scalping is while day trading takes a place over a daily period, it is possible to trade on even shorter time frames. So you would say basically swing trading is much longer, as Mahmoud already explained, day trading over daily period, and scalping is even hourly or sometimes even actually on a minute or second basis even actually. So scalpers predominantly use technical analysis to make their trade decisions. The difference between the price people are selling and people are bidding, known as spread, is also an excellent opportunity for profit. So some investors will purchase an asset at a higher price or sell at a lower price to trade instantly. A scalper offers this liquidity of instant purchase and sales the market and makes money out of the spread. So I think scalping became a popular term, especially when the PS5, right, the PlayStation was released. There were a lot of scalpers. So it's a similar concept, right? You just buy it and then basically sell it for a higher price, but just on a very short time frame. So let's directly jump into an example with the next slide. So let's say we have Bob again. So Bob,
Just a question,
sure.
Volkan, sorry to interrupt. What would you say are the advantages and disadvantages of scalping, compared to day trading and swing trading? Are there any advantages that stand out compared to other trading strategies?
Yeah, absolutely. So I think all the strategies have their advantages and disadvantages. So scalping in general, let's start maybe with the advantages. So the advantage of scalping is it's relatively easily to, I would say, to execute. You just buy it and then you just sell it when the price is lower, right? You follow the charts. So in terms of required knowledge is not as much knowledge required as other strategies, for example, on a longer time frame. In terms of, so I would say this is the most significant advantage. It's relatively easy to directly get into it, buy and sell. In terms of a disadvantage, there are actually a couple. So the first one is you need to be always following the charts, right? It's just instantly always follow it. There are also certain bots who can help you with that. So automated bots that would reduce your time effort, I would say. You can set certain price targets. You mentioned it already for buying and selling. That would make it easier. Besides that, usually for scalping, a higher amount of money or investment is usually required. For example, if you just have $10 and want to scalp the difference of 5 cents in the next slide, actually, there's one example. You spend a couple of minutes or maybe hours and then earn just 5 cents. But if you would have a much larger cash amount and investment amount, let's say 1 million, this amount, like this 0.5% would equal in 5,000, right? So the more cash you have, the I would say the more, not necessarily effective, but yeah, the more profitable it can be in terms of nominal terms for you potentially. So yeah, this is, I think, those are the two disadvantages. You need to be always on time, and then usually higher yeah, amount of cash is required. And then one more thing, if you scalp and like trade very frequently, usually exchanges have also trading fees, right? You need to also keep that in mind as well. So every time when you buy and sell, market takers, there's also some fee occurring. So this is also something that needs to be considered as well. So yeah, those are, I would say, the advantages and disadvantages.
All right, thank you.
Sure.
Yeah, maybe people in the comments box, they can also be interactive and tell us or let us know whether you are a scalper, day trader, swing trader. Would be interesting to know as well. But yeah, I will. We can maybe move forward with an example.
Sure, absolutely. So here we have Alice, and again our favorite one, Bob. So let's say Bob wants to sell a cryptocurrency. So this is the example what I mentioned, right? So cryptocurrency A for $10, but scalpers and other buyers want it for the lower price of $9.95. Bob offers the crypto to the market at $10, but he doesn't get any takers. So there, in this example, there's no trading fee, right? Bob is in rush to sell, so he chooses to sell for $9.95 to a scalper. Another investor, Alice, wants to purchase cryptocurrency A for $9.95, but sellers and scalpers only offer to sell it for $10. So Alice is also in rush, so she decides that she will meet the scalper's offer and purchase cryptocurrency A for $10 because she's in rush, right? So the scalper uses the crypto he bought from Bob for $9.95 and sells it to Alice for $10. So in this example, Bob earns 5 cents, right? So the scalper's profit. Bob is the scalper, and Alice is the person who is basically purchasing the asset or the cryptocurrency in this case for the um, price of $10 that Bob determined. So a scalper makes a small profit, and yeah, and this amount, like 5 cents, but they can make larger profits if they do transactions of hundreds of thousands of units in a day, right? So that's what I mentioned. Like ideally, when you're a scalper, you should have some sort of like cash reserves, because just for 5 cents, I'm not sure if it's worth your time. So you need to decide it, right? Everyone's situation is different. But yeah, ideally, the larger cash amount you have, the higher the profits, of course. And then scalping is definitely not for beginners. So even though it's relatively easy to execute, but it's still not a beginner strategy, right? You need to keep tracking the charts, be always on point. It's relatively stressful. It's actually also one of the disadvantages, because following always the charts on a second, on a for each second, I think it's also very very stressful as well. And yeah, the mechanics, technical analysis, it's also necessary to take into consideration, even though perhaps for long-term strategies you may use more indicators. For scalping, there's also definitely some indicators required as well, even though you may just follow the charts. But if you really want to succeed in it over a longer period of time, scalping, there's definitely some indicators you definitely also should take into consideration as well. So that said, for the traders that know what they are doing, identifying the correct patterns and taking advantage of short-term fluctuation can be highly profitable for scalpers as well. So yeah, this is for the scalping part. Then let's move on to the next slide and the next strategy, which is by far much more easier, and that's the buy and hold strategy. Um, Personally, I prefer this one. I used to trade, but this one is definitely, in terms of like when it comes to the advantages, is yeah, it's, I would say, less stress free. So if that sounds like, with the scalping, if that sounds too complicated for you, and you're looking for a strategy that requires less involvement, especially of your time, the buy and hold strategy may be the better solution for you and for your own personal strategy. This strategy involves, as it says already, buying and holding an asset over a longer period of time. So on the, like, if you would rate it, you have, on the very short term, you have scalping, then you have day trading, then you have swing trading, and then buy and hold would be on the end of the spectrum. So yeah, there's also some other strategies, but I would say those are the primary ones. It's a long-term passive play where you purchase an asset and leave it alone regardless of the market conditions. This strategy is known in the crypto sphere as hodling. I think we are all familiar with it. Investors can buy and hold a coin or token for years instead of actively trading. And this is a great approach for someone that prefers to be hands off and not worried about short term fluctuation. If you look over the past 10 years, one of the most successful buy and hold strategies has been to purchase Bitcoin and let it accumulate, let accumulate the value. While this sounds easy to do, buying and hodling requires patience on the investor's part. Though that time hodling Bitcoin, you would need to hold your nerve and not panic, selling any of multiple bearish market trends and dips. So in theory, it sounds easy as well. In theory, probably a lot of these strategies may sound easier, but in practice, once you're actually doing, we previous webinar we covered market psychology trends, right? So you may say, okay, hey, I'm just hodling, I'm buying and hodling for a long period of time, but do you really have the nerves if the prices go down to just keep hodling, right? So those are things you need to consider, definitely, in terms of psychology, in terms of like market sentiment, but also in terms of like your individual risks and preferences as well. Okay, I think we can conclude this module with a quiz. So let's
Just
go.
maybe a tip from my side, before really investing, and being investor, I'm not sure if everyone in the audience already invested in crypto or other kind of asset classes like stocks or REITs. So there are like various, simulations that you can also tap into first, to invest with fictive money, to see how you perform, and then you can start, with the minimum amount, and then you can gradually increase it as you gain like more knowledge and more expertise about, again, indicators. And yeah, just wanted to mention this as well.
It's definitely a good tip. The I would say though the human behavior changes if you really put your own real money into it, right? It's a very different thing. You might play with a little bit play game and play money, but if your money is really on the table, then the human psychology kicks off. So I would say maybe in terms of strategy, if you identify a strategy, try to stick with that strategy and try to really yeah, not necessarily play with it, but just try to see if that strategy works out for you. If not, maybe you can change your strategy. But I think the important thing is yeah, before you jumping into those different strategies, just be aware this is my strategy, and then also try to execute on that strategy that you predetermined for yourself as well.
I absolutely agree, Volkan. Perfect.
Cool. So let's go conclude with the quiz. Again, drop down in the chat your answers. Which of the following trading strategies is the most suitable for beginners: day trading, scalping, buy and hold, or swing trading? So A, day trading, B, scalping, C, buy and hold, or D, swing trading. So I see a lot of C's. I think this one we can, just disclose. Of course, is buy and hold, right? It's the easiest one. This one was easy. So okay. All right. So then we can continue directly with module 4. Now we are diving a little bit more into the technical part with module 4. Is the technical analysis and indicators. This one might maybe a little bit dry for some of you, but if you're really interested in trading, those are really the fundamentals that you need to be aware of. So let's start directly with it. So there are a couple of indicators. I will dive a little bit deeper into it. First of all, RSI, the relative strength index, moving average, Bollinger Bands, and then of course we have a quiz to give you some indicators. Okay, the relative strength index is one of the most common use technical indicators. So to call this, relative strength index, short form RSI. It's a momentum indicator that shows whether an asset is overbought or oversold. It does this by measuring the magnitude of recent price changes. The data is then displayed as an oscillator that can have a value between 0 to 100. Since the RSI is a momentum indicator, it shows the rate or the momentum at which the price is changing. This means that if a momentum is increasing while the price is rising, the uptrend is strong and more buyers are stepping in. In contrast, if momentum is decreasing while price is rising, it may show that sellers soon might take control over the market. So it just shows is a momentum indicator. Also to give some ideas, usually a good indicator, or I would say commonly agreed indicator for this one is when the RSI is over 70, the asset is usually overbought. So it means, okay, a lot of the momentum says, okay, a lot of people are right now buying it. So the momentum is overbought. And when the RSI is usually under 30, it's usually a sign of oversold. This does not mean it's something that is fixed, like just because it's above, even an RSI can go even up to 100. It still does not mean that the price very soon needs to decline. So it's just a momentum indicator. Take it with a grain of salt. As any technical indicator, those are just helpful, technical indicators. But it does not mean it needs to happen just because a technical indicator, displays into one direction. So that's the RSI, the relative strength index. Another very commonly used indicator, maybe even one of the most common used ones, moving averages. So the moving average smooths out the price action by filtering out market noises and highlighting the direction of the trend. The two most common used moving averages are the simple moving average and the exponential moving average. The simple moving average is plotted by taking price data from the defined period and producing an average. For example, the 10-day simple moving average is plotted by calculating the average price over the past 10 days. The exponential moving average, on the other hand, is calculated in a way that gives more weight to recent price data. This makes it more reactive to recent price actions. The moving average is a lagging indicator. The longer the period, the greater the lag. As such, the 200-day moving average will react slower to recent price than, for example, the 10-day moving average. So with moving averages, there's many different type of moving averages, but usually those are the most common used ones, simple and exponential moving average. And then on top of that, the moving average can be set in many different type of time periods. A very common used one is the weekly, the monthly, 50-day, 200-day. So those are all different type of moving averages. Depending on your strategy, if you're a short-term trader or long-term trader, or maybe just a buy and hold strategy, you may adjust your moving average according to your own preferences and according to your own strategy. Okay. Then the next one. Okay, so traders often use the relationship of price to specific moving averages to gauge the current market trend. For example, if the price stays above the 200-day simply moving average for a prolonged period, the asset may be considered to be in the bull market by many traders. Traders may also use the moving average crossovers as buy or sell signals. For example, if the 100-day simply moving average crosses below the 200-day simply moving average, it may be considered as a sell signals or a death cross. So yeah, I would say, in terms of like, to keep it relatively simple with the moving average, if the especially in this example, I think that's a relatively good indicator, the 200-day moving average, because it's a longer period of time, but again, depends on your strategy. If the price target is above it, consider it as a bull market. If it's under it, consider it as a bear market. And that's a relatively commonly agreed indicator. For not just for traders, but for technical analysis in general. So I think this is something you can, if you're really interested in technical analysis, one of the first indicators to look after, just to see actually how the chart is moving compared to the moving averages. Okay. So then let's go to the last indicator for this one. I think we are maybe speeding up a little bit. The last indicator is the Bollinger Bands. I think exactly, yeah. A measure of the volatility of the market. It can also be used as an indicator of the overbought and oversold condition. Bollinger Bands are made up to 3 lines: a simple moving average, which is the middle band, an upper band, and a lower band. The settling may vary, but typically the upper and the lower bands are 2 standard deviations away from the middle band. As volatility increases and decreases, the distance between the bands increase and decrease. So if the volatility goes up, the upper band goes up. If the volatility, if the price goes down, the lower band goes down. Generally, the closer the price is, the upper band, and generally the closer the price is to the upper band, the closer to overbought condition the charted assets may be, and vice versa. If the price touches the upper band, means it's an indicator that we are coming closer to overbought territory. And if the charts or the candles go closer to the lower band, it's an indicator that we are coming to an oversold territory. So I would say this is enough. There is a lot of material in here to digest. those are just some of the most common indicators to use for your own technical analysis. I hope it helps to assess your own risks and your own trading strategy. I think we can jump into the quiz, unless there's no question. Okay, so let's conclude this model with a quiz. So, which of the following statements is or are correct? A, all traders agree on which specific indicators are best to use. B, relative strength index is a momentum indicator that shows whether an asset is overbought or oversold. C, moving average is not a lagging indicator. Or D, Bollinger Bands are made up to 3 lines. So just drop down your answer. Is just actually...
Let's give them a couple of seconds to think about the correct answer.
Actually, I'm not sure if you uploaded the correct slide. I hope it's gonna display the correct answer.
Yeah, I've seen it. It's I think it's a good catch. It's not the right slide.
Okay.
But I have the solution in mind. Hopefully,
Okay. Maybe we just disclose it from our side, and you can decide to skip it. Okay. Let me see. Which of the following statements is correct? Indicators are best. All traders agree on which specific. No. Mount, I will give this one to you, and then I will.
No problem. Yeah, I can take this one.
Let's see if you listen.
Can you check the comments maybe?
Sure,
So
I will go with it. A lot of C, C, D. Oh no, A, B, D. We have across the board everything. A lot of B's and D's, I would say.
B and D's.
Yeah.
Yeah, it's actually the right one. It's B and D. So you have here the relative strength index as a momentum indicator, as Volkan already explained, that shows whether an asset, is overbought or oversold. Volkan gave the example with 70. I mean, you have the range between 0 and 100, right? So if it's 70, it's used as an indicator of saying, okay, it's overbought. And if it's like 30, it's oversold, right? And then C, no, sorry, C is wrong. D, Bollinger Bands are made up of 3 lines, as he already explained.
Okay. I see you listen carefully. So awesome.
Yeah,
okay. That's it from my end. Mahmoud, I will pass it to you for the next last module. And sure. Yeah, the stage. Right.
So build a well-balanced crypto portfolio. So we will explain how to build a well-balanced crypto portfolio. I mean, asset allocation, diversification, they are important in this process. And there are some general principles that you need to know when constructing your crypto portfolio. And yeah, getting started with crypto investing is as easy as purchasing, your first Bitcoin, so Ether or any other cryptocurrencies. After that, building a well-balanced crypto portfolio, it's not that different, from balancing a traditional portfolio. But when creating investment portfolio, you should be familiar, with the concept of asset allocation and diversification. And this is what we are going to talk about. And due to the lack of time, we are just jumping right into asset allocation and diversification. So asset allocation, just quickly, refers to investing in different asset classes. So Volkan already mentioned it can be stocks, it can be cryptocurrencies, bonds, then you have metals or cash. Diversification relates to, distribution of your investment funds across different asset classes or different asset sectors. And technically, cryptocurrencies, they are a single asset class. But in a cryptocurrency portfolio, you can still diversify, across various products, coins, tokens, that represent different goals and various use cases. Obviously, I mean, there are different crypto projects with different use cases, so you can decide with your knowledge, in which you want to invest and which industries you want to pick. For example, one way, to allocate a portfolio could be 40% Bitcoin, 30% stable coins, 15% NFTs, and 15% altcoins. Just to flag here, obviously, I'm not telling you should do this. It's just like an example on how you can structure or on how you can diversify your portfolio. It's important to know that, or to note that diversification does not guarantee, profits or protect against losses. The cryptocurrency market can be, very or highly volatile and unpredictable. So careful research, and risk assessment is crucial when you try to construct a diversified portfolio, and always make sure, you adjust your portfolio. So don't stick only with it, for a long period, because the market, is very dynamic. So a flexible, diversified portfolio is essential. Yeah.
Maybe real quick, just to emphasize one more time, this illustration is just an example. So definitely you already mentioned it. Yeah, just for context, and not that someone is following exactly this portfolio. So go ahead.
Yeah. All right. So what's the difference between diversified and concentrated? So generally speaking, the advice experts will tell you if you should basically diversify your crypto portfolio. While it is a standard, for investors, there are pros and cons to spreading your capital around different asset classes. So a diversified portfolio reduces first, overall risk and volatility. Obviously, crypto market, it's very, fluctuating, very volatile. So yeah, by using a diversified portfolio or by creating one, you can try to mitigate this risk. Secondly, losses, they can be offset by gains, and keep your positions stable. And thirdly, your portfolio also has more opportunities to make gains with each coin you own. However, that's very important to mention. The more diversified your portfolio is, the closer it will track, the overall market. Yeah, it can be like an index. So most traders and investors, they are looking to beat the market, so with larger gains, right? So a highly diversified portfolio will lead to more average returns than a successful concentrated portfolio, which makes sense, which is logic. So managing a diversified portfolio also requires, more time and research. So to invest soundly, you should understand first what you're buying. So with a larger portfolio, obviously the chances of understanding everything decrease. So if your portfolio is across, different blockchains, you may also need to use multiple wallets and exchanges to access your assets. So the decision to diversify or not is yours. So it depends really on your risk profile and investment style, but some diversification is always recommended. So we always say, don't put all your eggs, in one basket. I'm pretty sure you have heard about this quote. All right. So let's jump to the next one, portfolio trackers. So yeah, I mean, there are a lot of, portfolio trackers to manage your crypto portfolio, so to say. So just to quickly define it, it is a program, or a service that allows you, to trace movements of your holdings. So you can see how your crypto allocation stacks up with your long-term goals and tracks your progress. So some popular trackers, include CoinMarketCap, CoinGecko, and Delta. And like many portfolio trackers, they offer, customizable alerts and notifications. So, users can set price alerts, to receive notifications when a cryptocurrency reaches a specific price level. And this feature, allows investors to stay informed about market movements and take actions accordingly. Yeah. So portfolio trackers, they may offer also additional features depending on which one you choose just to enhance user experience. And this could include, for instance, also tax reporting tools to assist, with cryptocurrency, tax obligations, news feeds to stay updated with the latest market news, and social features, to interact with other users or follow expert portfolios as well. All right. Just to summarize, each investor or trader will have their own ideas on how to make or how to create a well-balanced crypto portfolio. But yeah, here are like some general rules maybe worth considering. So first, split your portfolio between high, medium, and low risk investments. And give them, appropriate weightings. Just remember the pyramid that I've showed before. So a portfolio containing a large portion of high risk investments is definitely not balanced. So it might have the chance, to provide you bigger gains, but may also cause huge losses. So your risk profile will determine what's best for you, but there should be a mix. Secondly, rebalance your portfolio if needed. That's what I've mentioned before. So don't have like a static portfolio. So because, again, the environment is quite dynamic. So you need to adjust your portfolio if needed. You should basically change depending on the current situation. Thirdly, allocate new capital strategically to avoid, overweighting any one area of your portfolio. So if you've made, big gains recently from one coin, it can be tempting to pump in more money. But yeah, don't let greed interfere and think about where you can better place the money. So again, it's about diversification, the right timing of exit, and yeah, don't be greedy. Lastly, remember to always do your own research and only invest what you can afford to lose. That's very, very important to highlight here. So your portfolio isn't correctly balanced if you feel, stressed about it. Your positions, they should not cause you serious consequences in case things go terribly wrong. And again, the crypto market is very volatile. Everything can happen. So be aware of this. By saying this, I will do the last quiz question.
Maybe before you jump in, let's. First of all, I think those closing lines are fabulous. I think those are really good rule of thumb that everyone should definitely take into consideration.
Yeah.
Besides that, I would like to give the audience to know a little bit more about you, right? Maybe can you share your own personal portfolio management, maybe in terms of percentage, or how are you allocated, if you feel comfortable answering that question?
Yeah, sure. It's not an advice. It's just like my personal experience. So just to give you kind of a background, I have a friend who's a day trader. So I tested myself. It didn't work out because it was too much stress, for me. So I couldn't handle with this. And that's why I switched, from day trading to a more buy and hold strategy. So this is currently what I'm following, with some rebalancing the portfolio. This is quite important for me. Again, so you know it yourself. It's a very dynamic market. So we need to be also reactive and proactively, change, adjust the weightings of the portfolio. The portfolio myself. So it's actually the portfolio of mine and of my father as well. So we are invested in like 50 or 60% in real estate. The rest is in crypto. With crypto, I mean like 30%, in Bitcoin and Ethereum, and 10% in altcoins. So I'm not sure if this is like well balanced, but yeah, for us it is, because on one hand you have real estate, which is quite stable, I would say. It's a quite stable asset class. On the other hand, you have crypto with volatile assets, but within crypto as well, I've chosen Ethereum and Bitcoin as the stable ones, so to say, and the rest is like 10% with altcoins. This is my portfolio. I don't know, Volkan, if you want to to share yours as well. Me personally, I would be interested.
Yeah, okay. I wasn't expecting that, but sure. So I think, I mean, I think if you ask 10 different people, probably you will get 10 different outcomes, right? So for me, personally, maybe I'm not sharing like the exact percentage, but I'm definitely very much into pro crypto. So, like, this is also definitely everyone needs to decide it for themselves, but I'm already a little bit longer into crypto, so for me it feels okay. I'm not really stressed out about like one of the closing lines. There were times, like especially in the beginning, where I recognized I'm a little bit too much leveraged and then getting a little bit stressed out, but right now I feel fairly comfortable with managing the risk, definitely. And this is, I think, also something to maybe as a conclusion. If you try, or if you start with investing, if you start with trading, if you try new approaches, like no one is going to be mastering it immediately, right? Maybe you have a lucky punch here and there, but over a longer period of time, it's definitely learning, a skill learning. So yeah, this is something that I learned personally for myself over a period of time. And right now I'm in a spot, despite the current global economic environment, I feel still very comfortable with my portfolio, even though I'm very heavily invested into cryptocurrencies. So I would say I'm well imbalanced, but I feel comfortable. It works for me as it works your strategy for you. And I think, yeah, I think to conclude, everyone needs to just decide for themselves what type of portfolio strategy and risk assessment works for them. So yeah.
Yeah, I think it's very important that you flag this. You know, having a well balanced portfolio is crucial. You know, to have like solid returns. But yeah, I think rebalancing is more important than just constructing your portfolio. It's nice to have on the Excel sheet how much percentage you want to have for each asset class, but rebalancing and like keep update of the market, etc., is crucial. Yeah, to keep the profits stable. So by saying this, I think we can give one more questions to our audience, right? So yeah, what are like some general rules worth considering when building a well-balanced crypto portfolio? Choose all that apply. This time we're gonna have two answers. Just a hint. No, actually, it's one. So A, allocate new capital strategically to avoid overweighting any one area of your portfolio. B, rebalance your portfolio if needed. C, split your portfolio between high, medium, and low risk investments and give them appropriate weightings. D, always do your own research and only invest what you can afford to lose. Or is it E, all of the above? So we're gonna give you 10 seconds, 15 seconds. Should be also straightforward, I think.
I think it's a very good closing question, this one.
Yeah.
So yeah, a lot of ease I'm seeing here, 1D. But yeah, I think overall, everyone
It's
seems to be relatively aligned. I think we can disclose it.
reveal it. Yeah. Okay. Yeah. It's
Yeah.
E. So it's all the points that we have mentioned. And yeah, so it's our last session, right? Our last webinar. It was a pleasure, Volkan. It was a pleasure to have you all guys here. I'm a pretty sad, that unfortunately comes to an end. But I'm pretty sure we're gonna have some follow-up webinars where we deep dive deeper into the topics if needed. But yeah, I hope we could inspire you about trading, about I mean, we start with blockchain, DeFi, Web3 in the metaverse, and now we ended up with trading. Yeah, any words from your end, Volkan?
Yeah, I mean, absolutely. It was a pleasure hosting it together with you. I hope everyone could grasp at least here and there something that may benefit for the future. So yeah, definitely also feeling a little bit sad, but overall it was very fun to hosting it together with you, those webinars. And definitely feel free to yeah, follow the next steps. for potentially for future webinars that we may host. And yeah, I would give the last word to you then.
Yeah, I mean the webinars, they are high introductory level. So if you want to know more about these topics that we have mentioned, feel free to check out our Binance Academy website. So we have like tons of articles, explaining the various mechanisms from beginner level all the way to expert level. So take this chance definitely to check out our website. And yeah, by saying this, hopefully we're gonna see each other very soon. And thank you so much for joining us.
Thank you, everyone. See you
All right,
soon.
see you. Bye bye.